trillion baseline budget deficits in fiscal 2020, fiscal 2021. Donald Trump put on $3 trillion of additional deficit spending on top of that. President Biden so far has put on $2 trillion of additional spending. So that's 5 plus 2, so that's $7 trillion of deficit. And the Biden administration is planning $4 trillion more later this year, which they're going to get probably before September. So that's $9 trillion of deficit spending. When going into this, the national debt after 230 years was only $22 trillion. So you just put $9 trillion of deficit on top of $22 trillion. It took, again, 230 years to get to 22, but we got to 31 real fast, just in 2 years. Well, doesn't that mean the economy is booming? Again, the answer is no. And the reason in the United States, this is not true in Australia, by the way, but it is true in the United States. Our debt to GDP ratio is 130%. That's one of the worst in the world. If you said, well, who else is kind of close to that? The answer is Italy, Lebanon, and Greece. There's your lunch table. Is that the group you want to be compared to? Even countries in Europe that are more more socialist than the United States, that the Americans like to make fun of in terms of fiscal irresponsibility, are better than we are. Spain is about 90%. Spain, France are well below 100%. Germany is even lower, closer to 60%. The US is 130%. And so what happens is, and the research on this is very clear, when you go past 90%, when your national debt is more than 90% of your GDP, your so-called Keynesian multiplier, fiscal multiplier, drops below 1. Now, what does that mean? Well, it means that at lower levels of debt, so again, Australia would be a good example of, you have 30 or 40% debt to GDP ratio. If the government borrows $1 and spends $1, you can get more than $1 of GDP. You can borrow $1, spend $1, and you can get $1.25 of GDP. So that's the stimulus that has some stimulative effect. Whether that's temporary or permanent, or just bringing demand forward, that's a separate debate, but it does work that way. Borrow $1, spend $1, get $1.25 of GDP. But above 90%, you borrow $1, you spend $1, and you get less than $1 of GDP. You might only get 90 cents or 80 cents or even less. That's where the United States is now. But the result of that, and again, this is simple math, is if you're increasing your debt by $1, but you're only increasing your GDP by, say, 80 cents, what's happening to the debt to GDP ratio? It's going up. In other words, there's more debt being piled on top of a given amount of GDP. The ratio is going up. Well, the ratio is the problem in the first place once it's over 90%. Now you're making it worse because you're still borrowing and spending, but you're not getting the GDP to support to go along with that. Your Keynesian multiplier is less than 1, so you're just digging a deeper hole. That's why you can't borrow your way out of the debt crisis. So monetary policy in the US won't work because of velocity. Fiscal policy won't work because the debt to GDP ratio is too high. And there's a behavioral adaptation. People look at that. You don't need a PhD in economics. You just say to yourself, hey, I don't know how this is going to end, but they're either going to have inflation or they're going to raise my taxes. The third way out is default. But the US doesn't have to default because we can print the money, at least for now. But people say there's going to be inflation or taxes. They're both bad outcomes. So people save more. It's called precautionary savings. And guess what happens when you save? You're not spending. So that affects consumption, and that's another reason that the economy is slowing down. So, so the U.S. forecast, I'm not forecasting a second recession, but I do forecast a continuation of a depression, much slower growth than expected for the reasons I mentioned. Let me just kind of recap a little bit and go through some recommendations for investors. I recommend a decent sized allocation to cash, perhaps as much as 30% of your portfolio. And people go, well, wait a second, cash has no yield or practically no yield. What good is it? I want stocks, or I want things that are going up. Well, okay, but cash has a lot of hidden benefits that people underestimate. One is that, first of all, it reduces the overall volatility of your portfolio. So if you have volatile assets over here like gold or real estate and other volatile assets like stocks and bonds, a slice of cash in the middle will reduce the overall volatility, so maybe you can sleep a little better at night. people worry about inflation, fine, but I would suggest that deflation may be a real problem, at least for the next year or two. And cash can be your best performing asset in deflation because the real value of cash goes up. But most importantly, cash gives you optionality. Obviously, based on what I've said, there's a lot of uncertainty, pandemic uncertainty, policy uncertainty, economic uncertainty. If you're the one with cash, you can pivot as visibility improves. In other words, if you're all in stocks and the stock market crashes, but you've got cash, you can go shopping in the wreckage. You can be the ones who picks up the bargains. Or if some other asset class collapses, again, the person with cash can buy those. First of all, doesn't lose because cash won't lose value, doesn't gain a lot of value except in deflation, but it won't lose value. But if something else does, you can come along and shop for the bargain. So that optionality, that embedded optionality is a very valuable aspect of cash. Residential real estate should do well. It should outperform, not for good reasons, by the way. It's because people are leaving the cities. The pandemic has taken what it's left cities with all of the detriments, which are crowds, noise, pollution, crime, etc., but none of the benefits. The culture's gone. The museums are closed. The theaters are closed. The restaurants are closed. Okay, they're starting to reopen. Life is coming back a little bit, but cities have been pretty dismal places to be, and the population density is high, which there's still the residual fear of the pandemic. So people are just leaving the cities and going to the suburbs or even going to the country. And that is part of what's driving this residential real estate boom. So residential real estate is an attractive asset. Commercial real estate is not off the bottom. It's too soon to jump in, partly because of the work from home phenomena, partly because, depending on the market, social unrest. And a lot of tenants are out of business or can't pay the rent. So commercial real estate is something you might look at in late 2022 or early 2023. Too soon to jump in. I recommend a 10% allocation to gold, physical bullion, keep it in a safe place. It's protection against inflation, but gold actually does very well in deflation. During the Great Depression, longest sustained period of deflation in U.S. history, gold went up 75% from $20 an ounce to $35 an ounce. So people kind of get the fact that gold does well in inflation, but they are not as well acquainted with the fact that gold does well in deflation also, particularly in a period of low interest rates when gold is competing with notes for investor dollars. Low interest rates make gold relatively more attractive. High quality government notes, Australian government bonds, U.S. treasuries will continue to do well. Interest rates have not hit bottom. They're low, but they can go lower, and they will.